Hey everybody, welcome back to another episode of Proof of Vision. Really good conversation today with Bear. He's the founder of Neutrl Labs. For anybody that doesn't know, Neutrl is I'll call it a next generation stable bearing asset, for lack of a better term. But they are building a very interesting model where they are essentially have a stable coin that's earning yield from the OTC basis trade is the best way to describe it, where they are getting OTC altcoins at a discount from various foundations in the top 50 to top 100, I think is what Bear said. They're making those delta neutral by hedging those on perpetual exchanges, and then they are obviously collecting the discount on the vested tokens that they bought, and using that as a yield source to kind of tokenize it and provide access, similar to what Athena did with the basis trade, right? Except for kind of a different flavor. Really interesting episode. We got into the structure of it. The growth paths for the stablecoin. Really great conversation overall. So if you're a stablecoin maxi like I am, and you're a yield guy like I am, then this is a great episode for you. So thanks for tuning in. Obviously, if you enjoy it, please like and subscribe, and we'll see you on the next episode of Proof of Vision. Thanks. Take care. All right, welcome everybody back to another episode of Proof of Vision. Got a banger for you today. We've got Bear. He's the founder of Neutrl Labs. How we doing, sir?
Great, and great to meet you. Thanks for having us.
Yeah, absolutely. Well, you guys have been building some interesting stuff. We were just talking about it a little bit off camera, off stream, but there's a lot of new yield bearing stablecoins, obviously, that are coming out. You guys have kind of come out with an interesting model that is not your typical model that we've seen, and that's why I thought it was very interesting, maybe to even have you guys on, is because I think you guys are doing some innovative stuff. But before we get into that, let's talk about yourself a little bit. Maybe tell the viewers how'd you get into crypto? What were you doing before crypto? Ultimately, what led you into the space and down the rabbit hole?
Yeah, sure. I started off very TradFi. I was at JP Morgan covering equities for a long time, and then I actually moved into a private equity VC office where we had $20 billion in AUM, but largely investing in incumbent and older type of assets like banks, asset managers, insurers, around like 2016, 17. And at that point, we did a few crypto sexes, exited those to DCG. And then around 2020, 2021, around DeFi summer, I moved to London, and I think I had an existentialistic crisis. I went to business school, something I thought I would never do, to be honest, especially that stage in my career. And I became one of the early members of the London Business School Blockchain Society. And it was around DeFi summer, right? So there was a lot of integrations with Oxford, Cambridge, etc. A lot of really good protocols coming out around then that are some of the blue chips right now that I got pretty close to. And I think I just never wanted to go back to TradFi. I just saw that there's a new type of industry, a new way that finance could be engineered, and a new type of economy that was happening. Unfortunately, I don't think it's really expanded that far since 2021, except for the big blue chip names. But saying that, for me, I just got deeper into DeFi yield farming myself and trading and just working on actual projects. Never went back.
Nice. Yeah. Many such cases, right? Many such cases. In terms of, especially if you have a finance background, I think I can't remember who I had on recently, but essentially they just felt like the design space in TradFi was already met. There wasn't too much more you could do in terms of designing new products that haven't already been built or that haven't already been scaled. And so when they discovered crypto, it's like this blank canvas. You know what I mean? There's so much possibility in terms of what you can build, and it is hard to go back, right? It's just that's what happened to me too. I was like, this is just way too interesting and too deep for me to ever really consider doing anything
and just
else.
when you think it's stopping, right, the learning curve, something new changes. That's what's insane. So I think there's always something, if you're a curious person and and you get a bit fatigued, like just doing the day to day in finance. Like, don't get me wrong, it's still a great career for most people. Um, but yeah, there's just a lot more other things that we could work on. And there's a lot of really smart people in the space at the moment.
Yeah, for sure, for sure. And honestly, like I think it's a good segue into neutral because like I think, one of the things that constantly kind of moves the needle for me is what's happening in the stablecoin space. Like for example, when Athena came out, I mean that was like even that blew my mind, right? Like I mean I knew about the trade, but like the concept of like tokenizing like these yield sources, I think was what kind of hit home for me is that you're actually tokenizing a revenue stream. And the tokenized version of that revenue stream makes it extremely powerful in terms of scaling, in terms of accessing that from the global capacity. So same thing, kind of bringing us into neutral, right? Like yield bearing stables or whatever you want to call them, yield bearing assets is highly competitive in
Mm.
terms of yields, in terms of attracting liquidity, certain hurdle rates you've got to meet. So like what made you think to build this model, and maybe explain neutral and what the model is, but like what was the edge that you think that you guys had, and why did you decide to go down the route of kind of like the OTC backing or the OTC yield source, sort of, so to speak?
Honestly, I think it's a very good question. It's something I took a long time to think about before actually launching Neutral, or the idea. Um, you mentioned Athena, right? Athena is the king. They created this model. They took one of the oldest, most trusted trades, if you're a trader, and tokenized it, and then brought DeFi composability to it. It's increased DeFi TVL massively across Aave, Pendle, etc. So it's just brought a lot of liquidity around that. Around neutral itself, I mean, when you look at funding rate basis, that's what most of these models are, either like RWA treasury yields or funding rate or some wrap on Aave. These things like often go in and out, different market conditions. And I mean, being a DeFi yield farmer like myself and some of the other members in the team are pretty big ones, realize that at certain points, like even if you're doing MEV arb or any like type of stat arb trading, this goes in and out with volumes, and it's not really like sustainable across many market segments. The OTC side is a trade that we've been doing pre-neutral, but saying that, I wasn't too sure, and I'll be very open about this, like how scalable it was. It was something that we were doing, and you earn really insane delta neutral yield. So you're not taking the market risk. We can explain that a bit later how it works. But how big could it actually get? And the first person I actually spoke to was Guy from Athena, the founder, to see if he thought it would be something that could work. Because I mean, I think they're one of the best teams in the space. Him and Jeff are probably the two best founders over the last cycle, the moment in my opinion. Jeff from Hyperliquid. And Guy obviously ran us through the ringers. Like he looked at all the trading that we did. He looked at the deal sizing, the supply of OTC that we actually could source, how scalable this really was, how we look at liquidity constraints, redemptions around turning into synthetic. And he's like, yeah, there is some alpha here. There's an edge and something you can do. And I think this is why we pushed through after that. We said there's actually is something that we could bring across into DeFi. Because this trade is done by most of the market makers that are pretty big, and most of the actual private funds in the space, like most of the names that crypto knows. And it's just being private, right? And they earn like anywhere between 30 to 70% type of yields on real trading yield. And it's something that the only thing that's been limiting is them opening it up or somebody actually having enough access to the OTC supply to do it themselves. So that's what we thought. Okay, let's do it. It's if we've been in the space for a long time, doing a private fund, running a family office with like 200 million, it is interesting, and you can keep on going. But we've been in DeFi, like most of my team members, and are on like crypto trading, institutional trading for the last like 6, 7 years. You want to build a product at some point and actually bring something different to the space.
This episode is brought to you by Pendle. Pendle is a leading protocol in the DeFi yield sector, operating as a permissionless yield trading protocol, facilitating the tokenization and splitting of any yield-bearing assets in DeFi. This allows users to speculate on future yield or earn a fixed rate on their assets. Learn more at pendle.finance. Yeah, absolutely. I mean, it's good motivation, right? And obviously it's a good validation when you have, a founder like Guy, kind of, again, validating your thesis. You mentioned the trade, okay, so which is probably the $1 million question here. Can you describe what the trade is?
Yeah.
Describe how it's structured. How do you get it? How do you get it delta neutral is a big question I have. Yeah, let's get into the meat and potatoes here a
Yeah,
little
so
bit.
the basic OTC arb trade is you buy locked tokens. So these tokens aren't fully liquid. They are vesting over time. They're in smart contracts. These can't be altered or changed. And you buy them from foundations, early VC investors, and some of the biggest protocols. Who have all, to be honest, like I've seen massive markups, even if the prices are down now on most L1s, L2s, and the bigger protocols. Like they could be down 80, 90%, but these guys got in so early, so they're willing to sell at a discount. The discount you usually get for these locked tokens are anywhere between 20 and 70%, depending on like duration of the vest and liquidity, etc. And then at the same time, you bring that into your own custody. So it's sitting with us now in smart contracts that will vest into our name. And of course, you have legal arrangements, etc. But I think the most important thing is having the tokens with you. You actually should use real good brokers. Like, don't just go to a random guy who says, I'm going to sell you this. You speak directly to the foundations with like top tier VCs or use brokers like Stix. They're one of the biggest in the space now. They're seeing like 80% of the volume on OTC for the last 2 years. And they're one of our investors as well. So I think that's what validated the actual idea because you need the supply. And then at the other side of it, you'll then start shorting a perpetual. So you got in here at the OTC discount from spot and you short perpetual here. And what happens is this actual discount, whether it's ranging from 20 to 70% over different like durations, it actually unwinds over time and you can capture that discount. But because you're shorting the perpetual, of positive funding rates also happen because for most altcoins, 75% of the time, it's actually positive funding, just the way contracts are structured on Binance, Bybit, OKX, Coinbase International, etc. You paid that funding for being short, as well as underlying collateral that even though it's OTC and locked, you can still earn staking yield on it. So it gives it another kicker. So that's basically how it works.
Gotcha. So I'm assuming then, so the hard underlying requirement though is obviously you have to have a way to hedge the token.
Yes.
So you wouldn't take any deal that you could not hedge,
No.
obviously, on perpetuals.
No.
And two, I think that flips in your favor sometimes. Like if the funding rate is in your favor, you're also earning, on the funding rate depending on which way it's teetering, right?
Yes. So there's two elements, right? In a very bullish like market environment, funding rates go positive, and sometimes like super positive. So you are earning that. In negative environments, like the 25% of the time over the last, let's say, 2 years, some of these alts, you'd be paying. But the thing is that's different here is why I think like a lot of people have thought about doing like replicating an Athena USDE type of model on other altcoins. And you see a lot of vaults like farming things across Hyperliquid and across multiple sexes. Those things come in and go, right? But those tokens actually turn negative quite often. You have to like keep rebalancing it, which is not a bad idea if you are quite sophisticated. But because of the discount that we've gotten, like for instance, I'll use an example. Like AVAX last year was on if you just did the normal Athena model, like spot and short perpetual at the same time, the funding rate delivered about 28% delta neutral. Like, but if you did the OTC trade that was available, it was 114% in the last 6 months. So the bigger like kicker comes from the discount unwinding. And like the funding rate does help here and there, but it's not really the bigger driver.
Yeah. And I would imagine too, though, if the funding rate's flipping in your favor, there's bullish sentiment in the market. The discount that you're able to get on OTC probably shrinks a little bit too, because people are not gonna be selling
You
for
would think that, right? You
really.
would think that. Like right now, I mean, we in private beta, we have 50 million that we've deployed and earning yield. Um,
Yep.
we'll be public pretty soon, but I could deploy 350 million like this week if we opened up. And this is in the top 100 like foundations and altcoins. Because a lot of these deals people don't realize are happening constantly in all market environments. Last year, foundations were selling because tokens were up. This year, VCs are selling a lot because even though the token prices are a bit down. They are down actually for a lot of these L1s, L2, like 80-90% from peaks. They still marked up like quite substantially from when they got in. So we still see like $100 million of like order flow a month now. And realistically, most of it is not what we would take, but there's still enough. And those discounts you can still negotiate. Like we got a big deal last night, probably for, if we had to deploy like 10 million into a top 10 protocol or like token um, at like a 60% discount. And the market's already pretty bearish, right? So, I mean, it just depends. This
Yeah.
stuff I had to validate
Yeah.
myself also, to be honest, because
Yeah, for
you have to
sure.
do it
Yeah,
for a
yeah.
while to realize that like how this will work out. Yeah.
Yeah, no, it makes a ton of sense. The way that you're describing, a couple questions come into my mind. I think obviously it's very early for you guys, but I would assume just like most yield bearing assets, right? You're going to want to create composability
Yeah.
for this asset. Um, from a user flow perspective, though, how do the users get access to this yield? Like, so obviously there's some duration involved here, right? Where
Yes.
you have this vesting, this lockup, in order to like access that yield. Um, are you having users like basically lock in at different durations on this curve, until it obviously comes to fruition where it's fully vested, or do they have to lock in for like the maximum duration of this vest to get all of the yield? Like, explain that to me. How does that
Yeah.
work?
So right now we have we've been given capital for a year, so that's quite helpful. Um, and we get to choose. I guess the average durations we're seeing on the deals that we have deployed is around 4 to 6 months. We haven't gotten much further down there. I think like most people also think when they think OTC, it's like normal vesting tokens, like 2 and 3 years, like cliffs, etc. I mean, that's not there. There's a lot of liquid tokens now that foundations will keep selling and they'll do a deal with you to actually with some sort of vesting terms. Um, but I agree. So what will happen is a user will come in, similar to our like the most simplified model is maybe Athena, the way that would work. You come in, you provide USDC, T, and we also accept USDE. And then in the back end, you mint it like NUSD. But what will happen is we will then actually deploy into either OTC deals that make sense and are duration matched. So a user will be able to stake for that. So there'll be different like durations that they can stake for, and then we'll make sure that we can actually enter into those deals. But if if it's something that we're not going to enter to, because the most important thing here is to duration match. So most of the book is actually liquid. So as a guy comes in, the OTC portion goes in if there's deals to do that, or the rest of the book actually goes into liquid basis, like across multiple sexes right now. So we're not just stuck to Athena or, I mean, well, Athena, USDE, or like Ethereum and Bitcoin basis, but you can look across different like six arb as well, even between like Hyperliquid, Bybit, Binance, OKX. This all like gives you a kicker. And you could even use USDE, to be honest. I don't know if most people realize this, but yeah, it's a collateral booster, right? Without staking. So that's how we'll like duration match the book. I think that's the most important thing because we want to be pretty safe around the product. And for composability, this also allows us to naturally make that synthetic work using the liquid side. And then the stake portion can kind of float instead of being like a hard pig. I think like a hard pig is it's very dangerous, not a bit dangerous. Right? We've seen examples of that. But as long as you provide enough information, I think the user, we're working on transparency dashboards that will come out now from what we've actually already been deployed. You can see the duration, you can see cash flows expected, unrealized returns that could unwind over time. It's something that will be quite interesting. On day one, we will be on most of the DeFi blue chip platforms.
Awesome. That's great to hear. And really the information is one thing I want to double click on too. And that's something if we're talking about Athena, so I guess I'll just use Athena as an example. They've done a really good job of outlining what the risks are, obviously, but more importantly, in my opinion, is kind of like this proof of reserve
Yes.
model that they've rolled
Yeah.
out. Is extremely important. But what they've created almost is like is transparency, obviously, but also there's ways like, so take a Pendle integration, for example, right? One of the reasons why it's so interesting is because you can sit here and look at the venues that Athena is putting on this trade,
Yeah.
and you can look at the funding rates. And if you think the funding rates are going to go up next week, well, maybe I'm going to go buy some YT, right? Some
Yeah.
YT SUSDE, or whatever. So it kind of creates this gamification of it, from on like the pendle markets and like some of the other markets. Um, it sounds like you guys are going to be able to kind of create that same dynamic, right, from a forecasting perspective on NUSD as well. Is that safe to say, or does that make sense from
Definitely.
like a game theory
No, I
perspective, like
think it's
some
the
of you're
most
trying to do?
important thing, right? Like some of the guys on my team, I mean, it's made up of traders that have been like either from TradFi, then institutional market makers, and running this specific trade for the last like 6, 7 years, and then big DeFi yield farmers also. And I think this is the stuff we thought about for a long time. What would the user actually look like? Like, I mean, what do they want to see? I think there's a mixture, right? I think Athena's done a great job. I also think like other protocols like Resolve has done a really good job also around doing it. So there's various degrees. Like we also need to have like proof of attestation on like the OTC tokens we hold, because we work a lot with big custodians now. They need to like prove to the user that it's there, and then we can provide like cash flow forecasts and even on the perp like how it's supposed to actually play out, and then yeah, the person would be able to work it out. I think.
Gotcha. Super interesting. Yeah. And then the one thing that just occurred to me too, based on what you were saying earlier about kind of like this, a lot of the capital is liquid. Only a portion of it is deployed into the OTC because obviously that's subject to like deal flow constraints and making sure you guys have the right discount and
Yeah,
all
I mean,
that.
like right now we
Um,
could, right? Because if we've got it for like 12 months, and it's guys who understand the trade that have backed us, like big institutions and other trading shops, we could go very high into OTC, to be honest. But I mean, I think it's just safer to go smaller. Um, it still gives you enough kicker, right? I mean, OTC right now, our OTC portion of the book is delivering like over 60% APR. The liquid side is delivering like closer to 18% because we're not just sitting in one like type of liquid basis, like we move it around. So I think that's still way, even on the liquid side, it's still way higher than than DeFi over the last 4 months, even when we had a big like spurt. So I mean, on that side, we're pretty happy because I think on the OTC side, we'll always like provide a higher APR, but there's duration like that needs to be matched. But on the liquid side, you need to at least be better than what's out there.
yeah, you got to be better than at least the money markets, right?
Exactly.
So it makes sense. Yeah, it makes sense. So then, okay, so going back to my user flow question. Okay, when you release this to the public, right, and more people can participate, you obviously have this pool of capital that has agreed they're going to lock their capital up for a
Stake,
year
yeah.
in
Yeah,
neutral,
stake,
and
you'll
that
see it.
so our when the public comes to the market though, when they come to neutral, are they able to choose how long they want to lock their capital in for, and then the longer that they choose to lock their capital up, the more yield that they get from the OTC opportunities, or from the overall yield strategy, or like how are you going to phase in
I mean,
retail, I
how
guess
did
is
you
my
even
point.
think of
How
that,
are
to
you,
be honest? Like, because we haven't made any of that public. But that's a very good,
I told you my background before this call, that's how I
yeah, it's
know.
brilliant. Okay.
But anyway, yeah,
No, so
yes,
I
yes.
think that's literally where we're trying to get to, right? Like neutral can't just be seen as another like it's yield bearing, but it needs to be like almost like a bond that's for like continuously like being locked up and staked, and that's largely how we work. That's like the early prototype now. So if somebody wants the OTC element, they will come in and they'll be able to choose their duration, and they will make sure that duration matches the deal, and then get the deal. So it's 100% right.
It's literally
It's
and not that this is exactly what you're gonna it's fractional reserve. It's fractional reserve, right? Um it makes complete sense. So then the risk that comes through on the other side, right? The liquid side of the system is a portion of this capital, whatever portion that is going to be deployed into like illiquid assets,
yeah,
essentially, right? And then you have a portion that's liquid that you can actually redeem people one for one if they want to get their capital
yeah.
back. So how do you guard against maybe like a bank run scenario? Like, let's say something happens in the market, everybody's rushing for the exits, and the liquid reserve gets depleted. What do you do then? Like, how have you guys modeled that
Yeah,
part?
so on that part, we looked at like different stresses, right? I mean, a lot of that's one of the biggest risks that we thought, and this is why I don't want to deploy more into OTC. So we need to keep at least over 80% into this liquid strategies that can be unwound very quickly across many of the custodian and off-exchange settlement that we have. similar to how you saw when Bybit was hacked, like I think 4 months ago. Athena was able to get out like 130 million and like very quickly. So I think that's just to be safer. So we can't have it like super locked. Even though the yield is much better doing this other trade, you need to protect that. And then another portion of it is like we are building up an insurance fund. So that'll be sitting behind it. And then a portion of like the smart contract, like right now we've done 2 audits. The last audit's being done now, and that's what we're waiting for, but it's all been good so far. A portion of that actually will be sitting on chain, so somebody can come in and redeem it. And I think like you need to keep a high level of liquidity. So you can't have something, even if somebody wants to do this trade and wants to go a bit higher, in the model that we've chosen, we can't have it super locked. We need to have a lot of liquidity. There's other aspects, right? I mean, that are worst case situations. And I mean, so we're working with one of the bigger institutions, almost create like a repo. Um, So, and then working with Sticks as well, the OTC broker, they're able to liquidate worst case. So, because we're not using super long tail OTC assets, these are tokens that people will buy. I mean, we'd have to sell that at a discount in the worst case, right? But largely, if we do get to that point, then we'd have to do that, or we'd have to lend out and pay out like to one of the institutions if we don't want to sell.
No, it makes sense. Makes sense. I mean, even in like a third option though, because I'm assuming you guys will probably have some DEX liquidity for NUSD, right?
A lot.
So people can probably use so they can use the secondary markets as
That's
well
that's
to
exactly it,
exit.
right? I mean, worst case, you could go to Curve, um, Euler, etc. You'd find out a way. We allow composability with Morpho and Pendle as well day one, so that would be it. But you don't. We don't necessarily want it, right? I think the person. I
Yeah,
mean, it's
yeah.
good. It's
You
good
don't
for
want to
the.
have to
Yeah, you don't
allow it.
want to have to because then it creates a spiral. But you also have people stepping in. So that's the other thing is we working with quite a few market makers, some of our investors, and like as well as curators, like some of the bigger ones, to actually
Yeah,
help on those situations. I think there's been a lot of
yeah. They can
learning.
arbitrage. They can
Exactly,
arbitrage it back to peg.
exactly.
Yeah,
It works for them too.
yeah. Makes sense. Absolutely, absolutely. I think yeah, models like this are super interesting because again, like especially with the transparency that you create, that's the important part is that people can see the durations that you're invested in, and then they can, properly model what their ARB rate would be,
Yeah,
and when they would take that ARB, and it just becomes a lot clearer. This is the beauty of the blockchain, man. I love this model because the transparency that the blockchain creates on this stuff actually solves a lot of problems with like TradFi type models of the same trade. Um, Really the second order implications of this are interesting to me as well. So we talked a little bit about the information, right? And the edge that you guys saw was you guys have enough experience and enough exposure to this market already that you can democratize it, right? Same thing for Athena, right? They had expertise in that. So the next question becomes the second order effects, right? So there is obviously a market for this that kind of happens behind the scenes already. Um, there's a lot of market makers doing this a lot that have not really brought this to the public for various reasons. Obviously, they want to protect their alpha.
mm.
As this gets democratized, though, do you see that maybe like the yields go lower at all? Like the competition kind of ramps up at that point where there's more transparency, the alphas watered down a little bit. Obviously, you still have an edge, but do you see that maybe happening as a downstream effect of democratizing it at all? Like the same way
Yeah.
like
No,
Athena would have
I
like
definitely agree.
a big difference on like the OI, right? But anyway, just want to get your
I mean,
thoughts there
Athena
real quick.
right now affects, I think, all DeFi yield, like in general. Athena and Sky, like they can almost be seen as they almost work interoperability with each other, right? Like if one goes up too high, like the other kind of increases yield or drops it, and they play with that. With us, I think realistically, we need to get to the point where I would love that to happen because I mean, I'd take a lower discount. You're still going to generate a higher on-chain yield than anything else out there across all market sentiment. It doesn't need to be 40% APR, right? I mean, that's the crazy numbers that people are getting. It could be 20% APR. If we get to discount levels that go much lower, and we still getting the best deals, and we're getting a lot more flow, that means Neutral did a success, was a success, and there's a lot more transparency around discounts. There's a lot more options for actual foundations to sell versus like just going to like three market makers that exist and have the actual capital to do it and negotiate the terms they do. I think it would be a really good win for us if someone could trust us at that point, that level. And saying that we are getting foundations that are coming to us now, which I thought would never come to us, because I think it's also really dependent on how you do this, right? I mean, we're not trying to like rinse anybody. Like a lot of it is like people can't sell that much tokens. Like there were like 7 deals earlier this year, like $100 million plus. If they had to go to the market and like drop it into any of these like tokens, they would destroy their prices, right? Then it would be a lot worse. And these are proper foundations. They actually come out with really good products. They're expanding now. These are names that everybody knows and still likes, right? And I think that's what you kind of need for your own growth. And often when you go to a market maker, honestly, like half of my team worked in market makers, so they know what they used to do. I'll be honest. And I think we realize that we have an edge to actually make this a bit more transparent also.
Yeah, no, it's all good things in my opinion. I mean, this is probably a good segue to talk about that tweet you had earlier today, but like we were talking about how the funds in the space are really spoiled because they have such like exclusive access to this deal flow, and you could apply that to like these liquidity deals. You could apply that to to the OTC's trade, right? And like because there's such limited participants in those trades, they set the terms,
Yeah,
right? I mean, they're the only buyers, right? And the minute that you open the floodgates on that, so it's like almost like what you guys are doing for this OTC trade is almost like what I would say like Turtle Club and Royco and some of these other people
yes,
are trying to do for like these private LP deals, right? And the moment that you do that, and the veil kind of vanishes, everybody has access to these deals. Everybody has access to these yields. It just becomes a much better flowing market. And then also you've kind of created this like again the same thing that Athena did with the basis trade. You've kind of created this economic stimulus into DeFi because you're introducing like another scalable yield
completely
source
new. Yeah.
like Athena. Yeah, it's interesting, man. It's interesting. Love the
Look. One of
model.
the our early investors, and he's actually I mean, I'm not going to mention who he is, but he started a hedge fund. He's a TradFi guy. He has no crypto experience. Everybody else on our investment, like cap table, or we didn't really like ship around like the deck. We just wanted guys that actually understand the strategy or big like prop traders or big like DeFi players and yield farmers. But he ran a family office, and right now he's retired because he like started one of the biggest actual hedge funds that existed in London. And he was just like, honestly, if you can deliver something like 12%, I mean, that's nothing for like crypto, right? I mean, for what you mentioned when you look at LP deal. But it's like if you're delivering 12% in real trading yield, that's like nothing I can get outside. That's delta neutral. I see this as almost like a distressed investing type of play. Um, like being OTC, even if the project isn't, but like the terms. And I was like, that kind of blew my mind. It's like because I think there's only so much capital and only so much yield in DeFi. Like even right now, you're seeing like even at Athena, right? Like doing a pipe, and I think they like Guy mentioned it pretty well, like in a tweet a couple of weeks ago around like how much bidding there is available for like also for actual like other type of projects in the space. And I think for us, a lot of funds, like back to your point on LP, a lot of funds like do come in and like take in very mercenary type of deals in terms, but it's difficult to like put it all on the fund because I mean teams also allowed, right? And I think that's the problem. And they don't look longer term because it's been pretty easy to raise money if you're connected in the space. And then if you're willing to give like a very big fund, like a really sweet deal, and it's basically free money. I mean, that's their mandate, right? They have LPs and they have performance hurdles also.
Yeah, for sure. I mean, and that's been the whole game, though. I think you see it in some of the. You already said it earlier, right? You see some of these charts, where, I mean, the game is to get as much TVL as possible, as quickly as
Yes.
possible, and then raise or do the TGE.
Do the TG in the 3 months that you have the
Not necessarily the
TVL
best
for, right?
outcome. Right. No, exactly. Exactly. And so, I mean, but it all comes down to PMF, right? It all comes down to product market fit. If you have a good product that people are going to use, and that they want to use, like post points campaign, post whatever, then ultimately I think you're going to do well, right? Or better, obviously. I'm saying something that's obvious, but I feel like it's not obvious because I see so many projects that I'm kind of like, I don't know if it has great PMF, but like, but you're also kind of playing this game at the same time. And so we're retail, right? Retail wants to kind of try to get an edge somewhere up that
Why do we
ladder,
need so
right?
many
Before
L1s,
it
right?
crashes.
Like, it doesn't make any sense.
Well, it's good for you from the OTC
Yeah, it is
perspective, I
very
bet. But
good
like,
for us,
you're
right? But
absolutely
like realistically, that's why it's good because like nobody wants
yeah,
that. There's nothing even happening on those L1s, most of them. Like um don't even go to L2s, right? But I mean like realistically, I think VC funded this. There's too much VC capital. I think like most of us kind of caught away to that, like especially from 2021 like cycle. Um, and maybe people were too bullish around like actual adoption. And right now, there's still more VC than liquid capital in the space. So when liquid capital comes to a project and they offer them like a deal and like you need to give me this much, they usually people know there's not enough capital, so they maybe cave to it. And on the VC side, those projects have already been given an exit. Those founders have already been provided like the roadmap, right? Some of them are selling like OTC before like the product comes out, before there's mainnet. But so I mean, it's only one way down after that, right?
yeah, for sure. I mean, I think without naming names, I think we've seen a few of those
Yeah,
in the
we
last couple
haven't
of
done
days.
those deals, right? But I mean, yeah, there's a lot.
Good. No, no. No, it makes sense. It makes sense. I think the last unanswered question about like the model, right, is like Neutrl Labs. Like how are you guys monetizing this? Where are you taking your fees?
Yeah,
How does that structure look for
it's
you?
very good question. I think at the moment we at the point where it's too early. All the LPs that we have are guys that are pretty big LPs into other protocols, so we want to make sure that they earn their return. It's all real trading yield. I'm not actually going to have to give them like token, Polynomial points, etc. to make it up, and then they come in afterwards. So there's no fees like right now. I don't know how that could change in the future, but like we're not actually trying to monetize it right now. I think it's just something we need to scale to a lot bigger before any of that can actually happen.
Gotcha. Makes sense. Makes sense. Well, thanks for bearing with me. You've answered all of my questions. Before we wrap up, though, because I think it's probably a good place to wrap up. Anything you want to tell the listeners in terms of things on the horizon they can get excited about? I know you guys are in private beta right now, but I think probably coming out soon. Hopefully, sounds like you got some audits going on. But what can they look forward to for you
Yeah,
guys?
no, I appreciate it, and thanks for the time. On our side, like we really like pushing very hard. We only came out around April. Been running this now. All the systems are working on the smart contract side. We've done two audits, like the guys who did Maker, Sky, and Athena. That point. So now it's just one last one, just to make sure it's all safe and secure. We'll have like DeFi composability day one with a lot of the blue chips, so that's been worked out, and we're hoping to get this thing out pretty soon. So like, I mean, probably in the next 1 to 1.5 months, like it all goes well. Yeah,
Nice, nice, nice. Well, excited for you. Obviously, if you're listening to this at home or watching it, check out the show notes. We'll link you to where you guys can find Neutral. Obviously, based on this conversation, I think they're doing some very interesting stuff. Definitely something you want to keep your eye on if you're into DeFi. But yeah, Bear, thanks for your
thank
time.
you, Kirk.
Really appreciate it. I know it's precious. We'll have to do this again after you guys go live, and we can dig into it a little bit
Yeah, I
more. So
appreciate it.
thanks.
Thank you, sir.
Yep. All right, everybody. We'll see you on the next episode of Proof of Vision. Take care.